Good morning. Welcome to Market Monday for June 16th, 2025. We hope all the fathers out there had a very happy Father's Day. Last week, we got inflation data for May, which came in cooler than expected. In fact, not one of the 73 economic forecasters in Bloomberg's survey had such a cool print forecasted. Economic forecasters, stock market analysts, who has worse predictions? Indeed, it was a rather cool inflation print, the year-over-year number being 2.4%. But what caught observers' attention the most was the change from last month of just 0.1%. Going back over here to the headline year-over-year number. Remember this? Owner's equivalent rent. We've talked about it so much over the years, and it represents about 25% of the total inflation number. Remember, this peaked at 8% a while back, but has been stubbornly slow to move, much slower than real-time rents. Here's the official inflation government data, and here are real-time rents. In fact, we see shelter inflation here. This is about 1/3 of the total inflation figure, so a huge weighting. This is going back to the year 2000. So we have a global financial crisis here, peaking during the bubble phase at just 4.3%. Then we have sort of a multi-year average of 3.5%. And now finally, we're getting back to this level. If this continues tracking lower, back to the multi-decade average, this should also bring headline inflation figures lower. To provide even more context, a financial firm called WisdomTree usually replaces this slow-moving government data with more real-time data. Doing so takes headline inflation, the number we just saw of 2.4%, down to just 1.55. So that begs the question, if the Fed has this dual mandate of stable prices, meaning low and steady inflation, and full employment, which lever should they be pulling on now? Meaning, if inflation is running hot, they think they need to raise interest rates to slow economic activity and inflation down. But when inflation comes down, do they need to keep rates high? Well, what about the labor market? Here's a look at continuing unemployment claims. So if someone loses their job, they file an unemployment claim and can get a modest amount of money while they're looking for another job. Here we're going back 1 year. And while unemployment claims are still quite low, it does appear they are trending higher. At the same time, a survey from JP Morgan asks, are jobs plentiful or are they hard to get? They calculate the number by taking the percentage of those who say jobs are plentiful minus those who say they're hard to get. Going back to 2022, this survey was almost 50, and since then, we've seen a persistent decline to where it is today, at just below 15. So clearly some cracks in the labor market are finally appearing, at a time when inflation does seem to be cooling. Now when the Fed meets later this week, it does appear they will be keeping rates steady. So we'll be watching for a cut at the late July meeting. And today we'll leave you with, now that the stock market has regained its tariff tantrum losses and is now positive for the year, the magazines are now warning us to start roaring. Same as it ever was. Have a great week.